appreciate y'all for attending. What I'm going to do is do my best to give you a very, basic overview, kind of a, 101, if you will, introductory lesson into the world of private mortgage lending. Really just teaching you, kind of giving you an overview of it, showing you, hey, how do you analyze a deal? How do you analyze a borrower? Making sure that you are setting yourself up for security first and foremost, and secondly, success, right? So I was looking at the markets today. It looks like the markets are going down, and that's one of the big advantages of private mortgage lending. When you do it the right way, you avoid this stuff here, these ups and downs. The ups are great, I get it, but the downs, they're horrible, and they usually wipe out the ups a lot of times. So we're going to teach how to kind of build a very consistent, stable investment opportunity for yourself and avoid some of these ups and downs. I'm not saying, don't invest in the stock market or don't invest in other areas, but this should definitely be something you consider allocating a certain percentage of your investment portfolio. Private mortgage lending. All right, so for those of you who don't know me, just kind of quick screen on, hey, why should we listen to you, Brant? So I've been doing this since 2007. That's when I began in real estate. I like to tell the story that I bought my first investment property with a credit card. The reason I did that was wife and I were still fairly newlyweds, so to speak. We had finished paying off student loans, credit cards, the bad debt that we had. We went through this whole Dave Ramsey thing because we had like zero financial education. And then I began to learn about, leverage and really getting financially educated, learning how to, utilize real estate, creative buying techniques, leveraging other people's money, banks' money, private lenders, hard money lenders. And I went full-fledged into real estate. 2007, about 10 rentals, began putting together partnership deals in 2008, 2009, and I did that while working a full-time job. Went full-time into real estate in 2009, and since that time, I've just been a very, hard-charging real estate entrepreneur. I've been licensed since 2009. I've written several books, as you can see there. I've been asked on Fox News and stuff like that. And all that's great. Like, it looks good on a slide presentation, stuff like that. But the bottom line is I'm just kind of a regular guy and not here to, promote anything. But really, when I started learning about private lending, it was just a huge eye opener for me, because it really opened up the keys to the kingdom for me to no longer have this limited mindset where I can only do X amount of deals, where it really became the more properties that I buy and the more properties I invest in, the more private lenders I get to work with, and more people I can help, right? And the thing I'm most proud of, and I've got a lot of things like in business that have been terribly hard. I've lost money on more deals than I'd like to talk about. And I've been through situations where my back's been up against the wall, and like, business isn't easy. 9 out of 10 businesses fail, right? And typically most businesses don't last over 5 years, but I've been doing this for 15 years. And what I'm most proud of is what you see is that last bullet point there, about 100% track record of performance, because I've always performed on all my loans, all my obligations with my private lenders. And the reason I'm saying that is, once again, not to brag or to boast, or to impress anybody, but to impress upon you guys watching this, whether you're watching it live or replay, is one of the most critical things as we get into this training, is that you really need to know who you're working with. What is their track record? How are they going to perform when their back's against the wall? Typically, you never know, like, there's not science here, but history typically is the best predictor of the future. And so you just don't want to put yourself in a situation where you're lending to somebody and they're not making a payment, they're not fixing the issue that they created, they're dropping a big pile of emoji poop, in your email or on your doorstep. You don't want to deal with that. Trust me, because I deal with those things. They're not fun. How do I deal with them? I deal with them in the context of helping other private lenders, and I don't want to get that phone call from any of you guys. My wife used to be a hairstylist, and she had a t-shirt that said, "I fix $7 haircuts." Brant Phillips sometimes gets called to fix bad lending deals, okay? And when I trace it back, I talk to these lenders, it goes back to square one. Who is your borrower? Okay, so we're going to get into how to analyzing a borrower. I've kind of already covered this. You know, we've done, since I started in 2007, we've completed hundreds of single family transactions, from rental properties, flip properties, owner finance notes, even commercial buildings. In the last 18, 19, maybe 20 months now, we've bought an RV park, multiple mobile home parks, an entire 51 lot subdivision. And yeah, so we've kind of done a lot of everything, and getting close to pushing like $50 million that we've borrowed and paid back or performed on since 2007. We've got close to 7 million right now invested, actively invested into the market. And we are on the brink of closing on a 100-acre deal, land development deal in Angleton, where we're developing, we're calling it an affordable housing community. Homes, manufactured homes on half-acre to 1-acre lots. That's going to be about total all-in $13-14 million investment alone. Super excited about that one. It's right off of a major highway, 288, and got the land just super cheap. So pretty excited about that. And then those last bullet points you see there, that's something I talked about on the other slide where, yeah, hey, I've got a 100% track record of loan performance, but not of success. Okay, like I said, I've made plenty of mistakes, but I've always performed with my lenders. And it's really important to me. It should be very important to you when you analyze borrowers. All right, so let's talk about what I'm not. I'm not an attorney. I actually applied for law school. Quick tangent. I was in law enforcement for 7 years and was kind of burned out with that. I'm like, what do I do? And I applied to get into law school. I didn't get in. I did really good on my LSATs, by the way. I have friends in law school like, oh, you're a shoo-in. I don't know. The economy was down. They said whenever the economy's down, applications go up. I didn't get in. It's a huge blessing in disguise. I would have, like, no offense if you're an attorney, but I would have not enjoyed being an attorney. I'm not an attorney. I'm not an accountant. I'm not a certified financial advisor. And my attorney told me to say all this. Like, I'm not promising, anybody watching this, you can make a lot of money, that it's easy, that it's risk proof, that it's guaranteed, that it's all that kind of stuff, right? So I'm not offering any security opportunity to invest with me. This is my why. This is why I do it. This is why I do everything I do. I just show a picture to my family here. And yeah, we have a lot of kids. I like to flip homes and buy rentals, do real estate deals, and my wife likes to have babies. So there we go. That's why we do it, though. You got to have your whys and your missions and your goals. We were without power last night, so we're sitting around with our kids talking about goals and doing stuff like that. So that's fun. All right, so on with the show. So successful investing is about managing risk, not avoiding it. You've probably all heard of Benjamin Graham, this Warren Buffett's partner, right, at Berkshire Hathaway. This is so true, right? This is so true. I see so many people, they stay on the fence and they don't get into the game, and it's really because of fear, okay? It's really because of fear. So my experience has been as whenever experience, or I should say education and experience increase, fear subsides, fear decreases. So rather than being concerned about risk and being fearful and never getting into the game and avoiding it, just increase your education, increase your experience level after you get educated. I'm still to this day continually educating myself, trying to get better as a business owner. I spent about $20,000 late last year with a consulting firm to come in and coach me and my team, me and my COO. And 2 days from now, I think, we're flying out to Ohio. Paid another coach a lot of money because I've got fears, of going to the next level and how to expand, and I don't know what I don't know. So the way that I'm managing my risk of taking my company to places I've never been before is, going, consulting and working with people who've been there, have done that. Okay. So don't let fear keep you on the sidelines. And before I go to the next slide, share a very quick story with an old coworker of mine. This is back when I was in the corporate world, when I first started buying real estate. And I told him and a couple of other coworkers, hey man, I'm doing this real estate thing. I bought some rental properties, and several of them like, man, that's cool. I've always wanted to do that. Well, this one particular gentleman said, man, that's great, man. I've always wanted to do that. He was very excited, to hear what I was doing. And, 5 or 6 months later, I had like 5 or 6 rental properties. And he's like, oh my God. He's like, how did you do that so quick? And I'm like, well, this is what I'm doing. I joined this club and I'm doing this and blah, 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 blah. Start walking through what I was doing. Well, at that point in time, I was really beginning to figure out when I was going to leave that corporate job, which I couldn't stand. So I was like really wanting to count down the days. So I was like, you know what? It's probably my best interest that I just not talk about real estate stuff up here. I'm just going to come in, when I'm at work, I'm focused on work. And I was in sales. So, I couldn't slack anyways. And I was top number 1 or number 2 performers in my territory. So that was an issue. I was going to give them, I was going to hit my numbers pretty much. And I did, but I stopped talking about it. And fast forward 2 years later, I was quitting my job. And so I talked to this guy again. He's like, dude, I heard you're quitting. What are you doing? I'm like, I'm doing real estate. And he's like, what are you doing with real estate? You getting your license? I'm like, yeah, I got my license, but I'm kind of doing this investing thing. And I told him, he's like, how many properties do you have? I'm like 25. And he's like, oh my God, I've always wanted to do that, and he had not taken any action in those 2 years, less than 2.5 years. Well, I talked to him 2 or 3 years ago. Okay. Now we're talking 10 or 12 years. It was the same thing, man. I've always wanted to do that. My wife won't let me do it, blah, blah, blah. Excuse. So don't be that person. Like, get into the game, get your education, make an action plan, get into the game. So what are some of the advantages of investing in real estate? If you're watching this, you probably already know, but I'll just put them up here and let you look at it, right? And so it's a hard asset, okay? High cash yield. It's leverage, and this is really a little bit more so for the eyes of the borrower, but you guys as well, because there are ways that you can leverage, and I can get into that later if we have time. There's tax advantages and there's equity buildup for real estate investors. Okay, so that's what draws people to real estate. People like me who want to get in and get their hands dirty and do all the stuff that we do: sales, marketing, closing, management, all that kind of stuff. Dealing with broken pipes during a freeze like we're dealing with now, versus some other investment opportunities out there. And we know that there's a lot of different opportunities out there. So let's talk about private real estate lending. Like, really, what is it? So it's very similar to bank lending, except there's not a bank involved. There's just a couple of individuals. And private, mortgage lending or private real estate lending, whatever you want to call it, is primarily used for, when a private lender loans to a real estate investor, whether that be an individual or a company, like if someone loans to our company to purchase real estate, perhaps refinance real estate, perform, a construction or rehab on a piece of real estate, or even a big development project like we're working on, for example, via PPM. Those are things that people do. When it comes to underwriting, there's different underwriting standards than a bank or other, conventional sources of financing. But the cool thing with private lending is you guys are the underwriter. When you are lending to somebody, you get to set the guidelines on what it is that you want to have from that borrower: credit scores, cash reserves, experience, comps on the house, rehab, but whatever it is that you want, you can ask for whatever it is that you want. I'll give y'all some lists of things you can ask for. Rates are typically between 7 to 12%. Sometimes they're higher, sometimes they're lower. We've paid as little as 5% on our private loans, and some of you guys looking for 10 or 12% loans, I understand I usually loan at 12% or higher than that. So I'm doing a lot of lending myself now too. But I lend to very inexperienced borrowers, so therefore I charge a premium. Because you can kind of tell the experience of the borrower by what they pay for their money, is a phrase I like to say. But I've worked with a lot of people that, they've got their money sitting in a CD, or some savings account earning less than 1%, which inflation's whatever, 2 to 3, whatever it is. So they're probably losing money. And so I ask them, hey, what rate of return would you be happy with? I have some people really happy with 5 or 6%, provided that it's secured, it's consistent every month. And so we do get rates at that, but typically 7 to 12%. On average for us right now, we're borrowing at around 8% these days. And this is really important. This is probably the most important bullet point of the entire presentation, is that it's asset-backed protection provides security, right? So if you are not doing some of the things that I'm going to highly recommend, or at least show you the way that we do them, then everything we're talking about is null and void. Because if you don't do the paperwork the proper way, if you don't have, or if your borrower doesn't do it the proper way, then you are not securing the asset. Then real estate is not a great opportunity at all whatsoever. So you got to do it the wrong way. When you secure that real estate the right way, analyze the borrower correctly, analyze the deal, then this is what I think we all want, right? We want to hit the easy button. We want solid, predictable returns, like each and every month. That 8%, whatever it is, it's coming there into your mailbox, into your ACH, whatever it may be. And it's mailbox money, right? And it's probably even better than that because everything's done digitally now. But it's not something where you're worrying about it each and every month. Hey, is this payment going to come in? Or like you're looking at the stock market. Today when I looked at it, everything was red. You don't have to worry about that if you've done things the right way, where hey, it's the first of the month, I'm going to get my return on my investment. Okay, so this is a huge benefit to investing as a private lender, and that is you invest in real estate and let someone else do all of the work for you. So these are kind of some of the benefits. You get to act as the bank and determine the terms and the property types that you want to invest in. Once you set that rate, just let it grow. Like it's your golden goose is going to lay that proverbial golden egg each and every month, right? Like you invest $100,000 with someone at 8%, and each and every month you're getting that 8%. And then at a certain point in time, if the golden goose, the 100,000 comes back to you, reinvest that plus all the interest you've earned, and begin reinvesting that 8%. And that's kind of the way it works. The bullet point over here, the little slide here, says less liability than owning the real estate yourself or in your IRA. So what do I mean by that? There's a lot of liabilities and risks and headaches that come with owning real estate. Trust me on this, there are. Once again, I refer to all the broken pipes and issues that we've been dealing with now. I'm referring to COVID, tenants not paying, evictions, forbearances, all this kind of stuff. So there's a lot of headaches, there's a lot of liabilities that you need to make sure that if you want to do deals that you're really wanting to do with all that stuff. Whether dealing with that stuff yourself or building out the team and having the overhead and all that requires too, because that's a lot. Or even owning the real estate in your IRA. So I'm not an IRA specialist. Anyone, I can contact you with a good friend of mine. He was a co-author of my book, the Private Lender Playbook right there. I forgot to mention that earlier. So when I wrote my book, The Private Lender Playbook, thank you very much, which is this book here, Private Lender Playbook, I had a good friend of mine, Nathan Long. He's on the back cover. And it says with Nathan Long. He's an IRA specialist. So I would reach out to him and his company on particulars about investing in your IRA. But there's a lot of red tape and a lot of paperwork and extra documentation and some other risk in investing in your IRA. So I would get educated on that. I have a self-directed IRA for myself, my wife, and all my children. I choose to lend my IRA out to other investors because that's very clean and easy versus buying real estate in my IRA. Okay, so just think about that. Private loans can be very extremely low maintenance asset, right? Like check your account once a month and make sure that payment comes in, and make sure that the insurance is in place. And when it comes time for a payoff, make sure that you're collecting all the interest that you're owed. And then the last thing here is you can partner and combine funds with other investors, family and friends, and things like that. So there's a way to leverage your capital with other friends and family members' capitals. All right, so let's talk about why would a borrower use a private lender, right? Like me, like why do we borrow private money? So here's some of the reasons. This is pretty typical. Want or need a quick close. Most of the sellers that we're working with, we do a lot of marketing for, hey, we buy houses fast. So if we're saying we buy houses fast, that's what we have to do. We have to buy houses fast. The banks, they don't do anything fast, all right? So there's a true need for, oh my God, I'm gonna make a Top Gun reference. There's a need and a need for speed, okay? Don't hold that against me. But we have to close quick a lot of times, and banks don't like that. They are not equipped to do that. Number two, we need loans or funds typically for a short period of time. Our fix and flip deals are usually 5 to 6 months. Sometimes we just finished a couple and they were 60 to 90-day turnarounds from start to finish. Meaning we bought a property, did a super quick make-ready rehab, listed it, immediately went under contract. We're in a very hot seller's market with low inventory, so houses are flying off the market. And then we're like paying our lender back like 90 days, kind of very, very quick. Banks don't like that either, right? They want long-term kind of loans. Some investors have weak credit or income documentation. When I got started, I've always had good credit and I've always maintained like 700-800 credit score. But in the beginning, I had a corporate job, but I didn't make a lot of money. I had no assets. Like I said, my wife and I just finished paying off credit cards and loans and stuff like that. So we were not looking good on paper, to be quite honest. But, even that being said, if I was working really hard at getting good deals. And so if I was bringing a good deal to the table that had, 25, 30, 35% equity in it, was that not a good credit risk? I think it was, so that's why, the banks are going to say no, but private lenders say yes. I say yes to, honestly, that's a lot of who I like to loan to myself, just kind of give you views in what I'm looking for. Me, I like to lend to the old me, right? I like to lend to people who are just getting started in the business, who may or may not really know what they're doing, but I can still get a good pulse on if they have a good game plan. I can give them some insights, kind of steer them in the direction if I see they're maybe going the wrong direction. But the bottom line is I'm only lending on deals that I would personally be okay taking back, okay? But I've got a lot of experience in this. And like I said, you can tell the experience of the borrower by what they pay for their money. The experience typically of my borrowers is very little. So I charge a lot because they have very low experience. But as their experience grows, or as an investor's experience grows, theoretically, you should be able to borrow money at a lower interest rate. And that's why we borrow like 5, 6, 7, 8%. But my lenders typically are, what are they getting in return for that? I guess peace of mind, the experience that I have and track record and stuff like that. So that's just something to keep in mind. But going back to the slides, why would a borrower use a private lender? Kind of like I said, that bank loans, they don't make sense. We can't close quickly. The banks don't like to do short-term loans. The paperwork alone involved is so tedious and time consuming as opposed to a private lender transaction. And we still provide all the paperwork that's necessary. We just don't do unnecessary stuff that banks do, right? It's kind of like working with the government. I'm just saying. And last one is, it's more cost effective and efficient than hard money loans. And hard money loans, if you're not familiar with those, they are kind of like private lenders, but they're loaning at 12%, 2 or 3 points, all this kind of stuff. And that's how I got started in the business. Primarily was working with hard money loans. And then I took the training wheels off, so to speak, and kind of graduated to working with private lenders. And private lenders really, the private mortgage lending industry has really filled the gap, okay, between the banks and the hard money lenders, if that makes sense. Because there is a, pretty wide gap between banks, say at 5% interest, hard money lenders at 12 to 14% interest. And that's the way business works, right? Like if there's a variance in, competitors or things like that, there's usually like some middle ground or middle market and middle opportunity. And that's what private lending is. I hope, hopefully that makes sense, guys. And if you guys have questions or comments, go ahead and post them in there. I may or may not answer them right now, but if something comes to your mind, go ahead and push it out, get it in a little chat section so I can cover that at the end. Okay. So any business venture, anytime you set out to accomplish something, create some results, it all starts with kind of like goal setting, right? So what I encourage everyone to do is define your ideal investment, what type of properties you're looking for, what are you most comfortable with, single family homes, commercial, multifamily, others, like we're investing in mobile home parks now and things like that. I would say kind of the rule of thumb on that is, I'm not sure if this is a Buffett thing or just general common sense thing, is like you don't invest in anything that you don't understand. Primarily people invest in single family homes, right? And single family housing, fix and flips and rentals, because those are pretty easy to understand. It's the majority of the opportunity in the marketplace, and that just kind of makes sense. Some commercial deals and other deals like that can be a little bit more tricky. So I'm not saying don't do them. I'm saying make sure you understand what it is that you're investing in. That's just 101. And then also in the, worst case scenario event that you had to take a property back, which if you do this right, could actually become your most profitable scenario, but there may be some work involved. Also look, if you're looking for short-term or long-term, right? I'll talk a little bit about the tortoise versus the hare, short-term investing versus long-term investing. It's a very similar conversation to, long-term investors in the stock market versus, short-term little slide traders and day traders and all that kind of stuff. And then rate of return. Once again, typically, and I say this typically with an asterisk, if there's very little risk, meaning like it's a very safe deal with a very experienced borrower, very little effort on your part, they're doing everything turnkey, concierge services, probably, that's going to fetch a lower rate of return for you and for them. And if you're both happy, great. If it's a high risk deal, I have an agent of mine. I've got a team of agents in various markets that reached out. I've done multiple loans with this guy. I love him. And he's always performed. He sent me a deal this weekend on a fire damage house. And I was like, I need to think about that. Fire damage properties they're more difficult. There's more risk. I've done some of them and they were incredibly difficult. So I had to kind of vet that situation out and things like that and tell them, hey, I need to think about that because there is more risk. There's more risk of him going over budget, of time delays, things like that. It's more effort on my part, a little bit more, am I going to be laying up, laying night thinking about this deal, concerned about it. So anytime that there's a bigger rehab, right, that's just more exposure to risk, more exposure to a hurricane, more exposure to a flood, all this type of stuff that we deal with, right? So you just have to think about those things. Like right now, we're working on this development deal, like I mentioned, and we're raising several $1 million on that deal. And it's a development deal. Like, I'm not naive. There's higher risk. I'm not asking lenders, hey, invest with me for 5%. I'm not doing that. I'm saying, hey, I'm going to give you 8% plus I'm going to give you equity, like 20% equity or something like that, because there's more risk. So I want to pay my investors accordingly. So you just need to think about that. So let's talk about where the borrower's at. They're everywhere. I like to say they're hiding in plain sight. Networking events, education events, these are things that used to go on all the time. Not so much these days, but they are starting to open up. That's probably your best spot. Look at different social media sites, social media groups, and just talk to people who are in the business, title companies, hard money lenders. Well, you might not talk to hard money lenders because you're kind of competing with them. But depending on how you structure your questions, you may be able to get some information. But they're all about in the marketplace, but you're really going to find most of them through networking, either in-person networking or via social media. And whenever you find some borrowers, you really need to begin to do a little due diligence on them, verify, get some referrals or references from them, verify their sources, kind of doing a background check, interview them. Whether it doesn't have to be a big formal thing, just over coffee, get to know that if they have an office, if they have a team, maybe, hey, can I come to your office, can meet some of your team, see how you operate. Check them out on social media. Whenever we're hiring a new team member, this is one of the first things that we do. You can learn a lot from people these days via Facebook, LinkedIn, Instagram, I don't even know all the social media channels these days. It's like there's a new one every day. But if you have teenagers, ask your teenagers to help dig up all their social media profiles. Some of it can be kind of, that's like a big disqualifier. We're going through an interview process. So look them up online and then ask for data. Like I said, you're the underwriter. Personal financial statement, if you want to look at their financials or credit report, find out how many number of deals they've done, how many years in business. And like I said, none of these things, if they have poor financials, doesn't mean that you're going to disqualify them. Like, really, this is asset-based lending. So there's two things that matter. The deal, okay? The deal, sometimes I say the deal and the dude, or the deal and the dudette, right? The borrower and the deal. You got to look at both, okay? And just because someone is weak, maybe financially, you got to understand a lot of people coming into real estate, they're starting from nothing. They have that mentality that I had where, man, there's a lot of opportunities. There's a lot of books on the bookshelf when they actually have bookstores. This is how I got started, going to Barnes and Nobles and bookstores. And I'm reading about all these books about how I could do creative financing and how I could, buy real estate with Ron LeGrand, no money down, and all these kind of books. So you got to realize the industry attracts people like that. And a small percentage of, small, but, a 10 to 20% of these people are going to be successful. Okay. Some of them aren't. So you just have to kind of figure out, hey, do I like the dude and do I like the deal? If you love the deal, you've got some issues with the dude, then you just got to structure it accordingly. Maybe they need to put some money down, some skin in the game. Maybe you need to be careful on the draws. Maybe you just got to work through that, okay? But there's not necessarily anything I'm saying here is a disqualifier unless you find something that, something that you're not in alignment with, core values, ethics, obviously criminal behavior, something where you are detecting that they're not going to perform, then to me, it's a no deal. Okay. But that's something you kind of have to screen people on these things. So we talked about the borrower. Let's talk about the deal, right? Let's give you guys some things, resources, and some checklists to do about how to analyze the deal. Once again, all this is in my book, Private Lender Playbook, privatelenderplaybook.com. This is not to promote my book or anything. Well, I guess it is. I just promoted it. But if you will message me, one of my assistants will send you a digital copy of this. Okay, a digital copy. Unless you're special like Blake, then you get a physical copy, right, Blake? Yeah. So kind of create your checklist, right? And this is not something you need to create over and over. The first time you do it, make some notes and just go through a checklist, right? So first thing, let's establish value. What's the property worth? Okay, you can do that through an appraisal, through a CMA, a comparative market analysis, or a BPO, a broker's price opinion. Let's look at CMA. Comparative market analysis is really just looking at other homes in the market and what they've sold at. Now, you don't necessarily have to have a real estate license to do that these days. There's so many platforms out there, but you need to kind of get a good baseline on it. I will tell you that the lending that I do personally, 80% of it are at medium priced homes and below. So in our market, they're usually about $250,000 or below. Those houses are really easy to find values on. Very cookie cutter, suburbs, subdivisions, starter price housing, 3-bedroom, 2-bath, 1,500 square foot, home, 2-car garage, 2.5 kids, 1 dog. No, I'm just kidding. But they're very, very vanilla. Those are very easy to comp. So you may want to just start that way. So after you get your the value on the home, and that's the most important thing, right? Bad data in, bad data out, you don't know what you got. If you feed the formula that I put below with good data, that's very easy to determine. So once you get that after repaired value, that ARV number, that's what that stands for. Okay. So let's say, for example, you get a lender brings you a deal and they say it's going to be worth $100,000. You do your research, you feel confident in it. Maybe you just ask an agent, a realtor, a friend, if you're not sure, hey, what do you think this is worth? If that property is worth $100,000, oh man, I think, okay. If that property is worth $100,000, then you got to figure out what you want to loan at, like what's your comfort level. If this is a typo in here, so I apologize. No, it's not. Let me see here. View percent, my bad. So if you loaned this person, let me pop this up again. Sorry about that. If that home was at going to be worth $100,000 and you times that by 70% of the ARV, that would lead you to $70,000. And the investor needs $25,000 in repair costs, then that investor should try to be buying that house at $50,000. Okay, and that's typically what we're buying properties at. Is usually 50% of the after repair value before we do the repairs. So the investor's maximum offer should be about $50,000. So if you are going to loan on this deal, $50,000 plus the $25,000 in repairs, that would put you at a $75,000 total loan amount. And then here at the bottom, it says that represents a 25% equity position. I hope that all makes sense. If not, let me know. I think I may have made that a little bit confusing. But the bottom line is, if this house after repairs is going to be worth $100,000, by this example, this is going to give you a 25% equity position. Okay. This is a very important number. What does this represent? 25% represents your oxygen, okay, in case the deal goes bad, okay, in case the deal goes bad. So this is not a hard and fast number. In certain markets, it's lower, like you want to see 30%. If we go into like a really hardcore buyer's market, if we go back to like a 2008 or 2009 time period, if all of these foreclosures and evictions hit the market, we could be back in that time very, very soon. So your oxygen or your equity position is very important. In today's market, which is seller's market, and depending on which geographical location you're in, like in Houston, for example, we have very low inventory, stuff's flying off the shelves. But I'm seeing investors saying 80%, like give me 80% loan, give me 82%, and I'm going to flip this thing in a week. that's bad business. They may be flipping a house and making $5,000 and thinking that's a good thing, and they don't know what they're doing. So you got to be very, very careful on how to analyze a deal. Now, the easy thing is if an investor comes to you and says, "Hey, let's take this example, right? This number, this deal as an example." And they say, "Hey, I need $85,000, loan amount." And you could just hold your position and say, "No, I'll loan you $70,000. You need to come up with $15,000 out of your own pocket." If they got it and they want to do the deal, great. If they want to get a second lien, if they want to use a credit card, that's fine, as long as you're in the first lien position, you feel good about it. Okay, I hope that makes sense. Of course, you're going to have to verify. There's really only a couple of numbers you really need to understand in real estate as a lender, right? It's this ARV number, it's the repair cost number. You're going to have to verify rehab estimates. Unfortunately, I don't have time to go too in depth with that today, but I talk about it in the book and on other YouTube shows and podcasts and things like that. But this is how you analyze a deal, and just verify the numbers and understand what you're investing in. Okay, I'm gonna go a little bit faster for time's sake, but so rate the risk factors. The loan to value, that's what we just talked about. Your 25% equity is very important. The experience of the borrower, the background of the borrower, the financials of the borrower. Do they have skin in the game? I'll be honest, I usually don't have any skin in the game, but I also, like I said, have hundreds of deals of track record, but that's just something you need to think about. The amount of rehab, okay? More rehab typically represents more risk, right? Getting in and out, like painting carpet and putting a tenant in, versus doing $100,000, $150,000 rehab from a fire damage, or you're doing some addition that's going to be 6 to 9 months. Markets can change, acts of God can come into play, like we've just dealt with this week with severe weather. Then you need to think about that. Draw schedule. They need $50,000, for example, for rehab. Are you giving them $50,000 up front? Or are you setting it up on a draw schedule? Very important question you need to ask yourself. Risk of the deal, like I mentioned, a vacant property, a flip property that's going to be vacant for 6 months to 9 months, shorter, longer, who knows, versus a rental where you've got a tenant in there. There's some safety and security with that, right? And it's producing cash theoretically. And then just condition of the market. Example, Houston right now, extremely hot, extremely low inventory. That's great. But also look at your sub-market, right? Like that's the big macro view of Houston. There's sub-markets in Houston right now wouldn't touch with a 10-foot pole, okay? So you got to know the market and the sub-market. And you just go with your gut test, guys. Like, you go with your gut, okay? If you've done your education, you've plugged everything in, you've done everything, something still doesn't feel right with you, just don't do the deal. Like, you ask yourself, you got to ask yourself, is it healthy fear or non-healthy fear, right? So obviously, we've probably all touched a hot stove. That's healthy fear. Like, we know that if we touch that, it's bad. Let's not do that again. Then you have to ask yourself other types of fear. My friend from corporate America who wanted to invest in real estate, but just couldn't get in for, fears, concerns, stories he was telling himself, things like that. You got to make sure, like, hey, like, I'm nervous about this, and kind of reverse engineer and kind of find out, why are you nervous? Is it really something about the deal, something about the market, something about the borrower? Pinpoint that, find out if that's something that you can satisfy with some data, some information, overcome it. Or if you can't, you just don't do the deal, right? And I always say, private lending it's relationship-based lending. I like to say it's a handshake agreement backed up by the proper paperwork. Okay, so let's talk about that paperwork and some of the ways to secure a deal. We always, and I say always, use a real estate attorney to prepare loan documents. We don't prepare anything in-house. I use a real estate attorney. I suggest you do the same, but I'm just telling you the way that we do things. Some of the documents that you'll get, note, deed of trust. We always provide a personal guarantee to our lenders. Find out if your borrower is going to do that or not. Title company closings. 98% of the time we do that. Anytime we buy a piece of real estate, sell a piece of real estate, we use title company. We've done some refinances, and our attorney does those kind of in-house and files a deed and things like that. But we do title company closings. We always have title commitment, title policy, survey, insurance, property insurance, clearly defined repair escrow terms, meaning if you're releasing that rehab money up front or if it's set up on terms. And then just working knowledge, understanding the terms of the deal. If you don't understand, I go to, there's no such thing as a stupid question. It's just kind of maybe stupid if you don't ask it, right? So if there's something you don't understand, you just ask. You ask the borrower, you ask the attorney, you ask the title company, you ask your insurance agent, whoever you feel like you need to ask to satisfy that question mark that you have. Ask, figure it out. And guess what? After you ask, you probably don't need to ask again, right? So you learned it and you take that, you extract that lesson onto your next deal. This is a very quick overview of how the process works. Feel free to take a screenshot or watch the replay when I post it. But borrower finds a deal, that private lender and borrower discuss the deal, the rates and the terms. Like I said here, the borrower and lender handshake agreement, agree on rates and terms. Then that information is sent to the attorney and really to the title company also. Any of you guys who work with me, we have a standardized loan doc prep sheet that we have that prepares everything for our attorney and the title company that outlines everything, borrower, lender, tax ID numbers, interest rate, amortized, interest only, payments due, all the title commitments, like the whole 9 yards. So we kind of button it up. So everyone's on the same page, and we kind of plug it into our system where our attorney prepares everything, title company's working on everything. It's very transparent. Everyone has clear expectations of what's going to come out the other side when we get to closing. Guys, this is really important. Okay. So when I say we close everything in a title company, like if you're lending to me, for example, if you're going to invest with me in my company, I'm never going to call you, ask you, or email you and say, hey, I need to borrow $100,000. Here's my account. Send it to me. We don't do that. It goes to the title company, right? We have a title company closing. It goes to the title company. Everything's done above board. Your funds are wired to the title company. Everything, note, deed of trust, personal guarantee, all those items, once those are signed, sealed, delivered, boom, stamped, recorded, then the title company releases that, whatever, monies there are, first and foremost, to pay off the seller, right? And if there's additional monies coming to us for rehab and things like that, that's when money exchanges hands, right? There are some, like I said, a 1 or 2% instances where it's a refinance or we're doing something with the attorney. Very rarely. The rule is you don't release money directly to a borrower. So I need to make sure you get that. Like it needs to go to the title company, and then you're very clear and implicit about how that needs to transpire, meaning title company, you're not releasing this money until everything is signed, sealed, delivered. So you basically are giving them your lending instructions, okay? So then after that takes place, a closing, renovations, draw inspections take place. This is the fulfillment, right? This is where, real estate investors like me, their teams, like I've got a full construction manager and the assistant who just manages construction. They're out right now, out in the 15-degree weather, renovating projects and getting things done. And so that's the fulfillment side of things. This is where it will magically become mailbox money, where, all right, so your borrower's, managing that asset and should be paying you. I have a little rule of thumb. If anyone out there is a real estate investor like me and you're looking to borrow from lenders, little pro tip: pay early. Okay, we like to pay our lenders early so they're not worrying the day day of, day after, 2 or 3 days later, are they sending my payment? That's not a good thought. That's not fun. So we like to pay our lenders early, definitely pay them on time, but try to pay them early. They like that. So then at some point in time, your borrower is either going to sell or rent and refinance a home. You'll get fully funded, and that's the golden egg. That's the goose, right? So I have, we've done hundreds of these things. I've only had 2 lenders now at the time of this recording, 2 lenders who've not reinvested with us. One, the first guy, he was really a jerk, and he came back and 2 or 3 months later, he's like, hey, I need my money. And we're like, this is a 1-year loan. We're renovating the house to refinance. He wanted the loan back. We had made our payments. We'd done everything, obviously. And when we did it, like I got out of the loan, funded him out. He came back about a month or 2 later and told me that, I was like, why did you want out of the loan? Because he came back, he wanted to reinvest with us. The reason he wanted to reinvest with us, because he found another investment he wanted to take part of. So it cost us a lot of stress and financial expenses for him to go pursue this other thing that fell through. And then he wanted to reinvest with us, and he was somewhat rude. So we politely said no. So don't do that, right? Don't get into this investment opportunity if you can't honor your commitments as a lender, right? If you say 12 months or 24 months or 60 months or 120 months, make sure that you're going to be able to fulfill that. There's some instances where I've had some other lenders who say, I've got this health issue, this medical emergency. No problem at all. Give us 30, 60 days. We'll get you out of this loan. And we have good communication, good relationships. I've only had one other lender who hasn't reinvested, and he said he's going to. He just hasn't yet. Something to look at, I'm going to wrap up really quick here, guys, is look at the short term versus the long term. Are you the tortoise or the hare? So the cool thing is with private lending is, I like to say, Warren Buffett kind of represents the tortoise, right? Invest for the long term. And, I think Einstein made some type of comment about, compounding interest was, the most amazing thing he'd ever seen in all his life. Compounding interest. Think about that. What do you have the ability to do here as a passive lender, as a private mortgage lender? Compound your interest. The way that you do that is keep your money working in the market. So it's really important. There's a lot of opportunities to make loans at, 12, 14% and earn points, multiple points. And that's really good, but it takes a lot of time. There's higher risk. And what I've seen a lot of times is lenders come into this and they don't have the time or the capacity or the deal flow or the relationships to keep that velocity of money working at that high rate. So if you're able to do that and you have the time, energy, effort, resources to do that, I say go for that. It's kind of like day trading, if you will. Like there's guys who are really good at day trading, but when the market correction comes, it's about to come soon, you're probably going to see the herd thin quite a bit, like 80 or 90% of those guys, they're going to be done. And that 10 to 20%, they'll be good because they're really focused on it and they have the time. For most people, what I see that makes sense is just be the tortoise, get your 7, 8, 9% interest, let it just compound, let it work. Hit the easy button, but you just got to figure that out. Guys, I'm not going to have time to go into my case study because of this, but these are typical kind of vanilla deals. 70, 75% loan to value. This one was a 68%, typical numbers, $106,000 purchase price, less than 50% of the ARV. This was because we got a higher price than we expected. 50,000, for repairs in the suburbs, very cookie cutter kind of deal. Same thing with the rental, $111,000 loan amount. Sorry about that. In the Houston market for a 3-bedroom, 2-bath, 2-car garage at a 72% loan position, pretty safe, in these day and age. This is a case study of an RV slash mobile home park that we did, an affordable housing community. This was a $600,000 investment that we've made. We bought it for $385. We put about $200,000 in improvements, capital expenditures, and we're in it for about $600,000. It's producing over $15,000 a month in cash flow, and we just received a $1.2 million broker price opinion on it. Pretty good, safe, loan to value, right? There's a commercial property that we did. This is another subdivision that we're working on. It's a 51 lot, half-acre subdivision that we bought for less than $400,000. That included 3 single-family homes. I'm just saying, like 30 acres of land plus 3 homes for 400,000. Pretty safe and producing income. So understand the deals that you're working on. This is what I'm gonna wrap up here. This is backyard investing that feels good. The stock market, right? It's great when it's great and it's bad when it's bad. You don't know what's going on behind closed doors. With private lending, where's your money going, right? It's renovating neighborhood homes and communities, like turning these ugly, distressed properties in neighborhoods. Like we're literally redeveloping an entire neighborhood that was incredibly run down. Reach out to me if you want me to send you a link. I'll send you videos of like the roads and just horrible situation. We're renovating, turn that thing around. We got people crying in tears how it's impacting their lives. That's what your money's doing. You're helping to renovate these communities, these homes. Your money's going to hire local contractors and service companies, buy materials from hardware stores, lumber stores, granite yards, mulch stores, all these types of places. And you're providing housing for hardworking families. And at the very same time, it's like win kind of deal. You're earning passive, recurring, above market rates of return with substantially less risk than other investments. That's why my lenders, that's why myself, that's why my parents, my in-laws, everybody who I've, just kind of educated or told them about that. Like everybody loves it. Like I've never had anybody who's done it the right way be like, oh God, that's terrible. Like everybody's like, that's great. When can I do it again and again and again? So it's Wall Street versus Main Street. In my opinion, if you do it the right way, Main Street wins. Check out my book. I'll send you a copy. And this is a testimonial one of my lenders wrote. And he just said, we found a better way. He talked about comparing, the stock markets and ETFs and all these other investment options that were incredibly complicated, somewhat risky, and hard to understand. And it's like, oh, I can loan to Brant $150,000 and make 8%. That makes a lot of sense. And there's equity and security. And they just do that. And we've been working together for about 10 or 11 years now. They're great. They're awesome. That's my information. If you have any questions for me, just feel free to reach out to me directly. You can look me up online and be glad to answer any questions or send anybody who's watching this either live or replay a book. And guys, I think that's it.